So here is a question from March July 2020 attempt. Extract from the draft financial statement for the companies for the year ended 31st December 20 X 0 are as follows. Fit company revenue is 250,000, Sporty company revenue is 200,000, cost of sales 190,000, 150,000, gross profit 60,000 and 70,000. Profit on disposal, note 3 on Fit company 5,000. Operating expenses 40,000 and 38,000. Obviously, I'm not considering millions over here. Profit from operations 25 and 32,000. Finance cost 7,500 and 1,000. PBT, profit before tax 17,000 and 31,000. Then we have draft financial position, cash for Fit companies 5,000 and 10,000. Total equity 90,000 and 60,000. Non-current liabilities 45 and 15,000. Trade payables 35 and 12,000. The following information is also relevant. Fit company is a manufacturer retailer of premium branded sportswear, which it sells online and in its own international chain of branded stores. Spotify company sells mid-market sportswear in department stores and online. It sources its good directly from the manufacturer and does not make international sales. Sporty company plans to expand into the international market during the next financial year. On 31st December, on 31st December, X Zero Fit company disposed of its investment in the active division for the consideration of the 10 million. The cash proceeds have been recorded as a receivables at that date. The financial statements were prepared and the gain on disposal is included in the statement of profit or loss above. The active division at the following ratios: gross profit margin 40, operating profit margin 5. Fit company also charge 100,000 per month to the active division for central services, which was deducted from operational expenses and financial statements. Okay. Now what we have to do, we have to, using the financial abstracts provided above, we have to calculate the ratios for both Fit company and Sporty company. GP margin, operating profit margin, trade payables days, return on capital employed, and gearing. That is debt divided by equity. He already gave you the formula over here, and 6 marks available for it, as you can see. Okay. Then we have to comment on the performance and position of both companies for the year ended 31st December 2000 X0. Okay, so let's do it. So now what we will do, we will compute the first. We have to compute the ratios. Question name is Fit company right now. Ratio A part. A part, and it is ratios calculation. I think just a minute. Right, ratios calculation. Yeah. So what we will do, ratios now. Firstly, we will compute related to the Fit company. Then Sporty company. So first ratio is gross profit. So gross profit for the Fit company was 60,000. Sorry, yeah, and revenue was 250,000. Let me do is equal to 60,000 sum 60,000 divided by 250,000 multiplied by 100. It's 24%. That means what you can do, you can specify percentage over here or over here. It would be better to do it like this, 24%. Then operating profit. What will be the operating profit? Was given 25,000 divided by what was the sales? 250,000. 25,000 divided by 250,000 multiplied by 100. What we will get? 10%. Trade payables days. Is equal to sum 35,000 divided by 190,000 multiply by how much days? 365. Let me do it again. Is equal to some 35,000 divided by 190,000 multiply by 365 days. 67.24 specified in days. Then ROCE, return on capital employed. PBIT or operating profit you can take as one, as nothing else was given. So is equal to sum 25,000 divided by its debt plus equity or capital employed or asset liabilities, non-current liabilities and current liabilities. So 90,000 plus 45,000 multiply by 100%. Yes, 18.52%. ROCE done. Then we have gearing. Gearing formula was specified into the requirement, that was debt plus equity. So simply is equal to sum 45,000 divided by 90,000 into 100%. 0.5, or you can say 50% as well. Okay. Done with the Fit company. Now we have to do same for the Sporty company. GP margin 70,000 divided by how much? 220,000 multiply by 100%. 0.318. Or what you can do, just both acceptable. Like this, it's also acceptable. Okay. So 50%. Now, in this same way, operating profit 32,000 divided by 220,000 multiply by 100%. Uh, Payables days is equal to sum given in this scenario 12,000 divided by 150,000 multiplied by 365. It's 29.2 days. ROCE, simple and easy, is equal to sum 30,000 divided by 60,000 plus 15,000 multiplied by 100. 42.67 days. Now, lastly, the gearing is equal to sum 15,000 divided by how much? 60,000 what's happening? Hmm, It's multiplied by 100 as well. Yes. 25% is our ROCE. Oh, sorry, gearing for sporty company. That's how you need to do the calculation, and you get 6 marks for it. Now we have to do the comments. So now comments, performance and position, and now first we will discuss about the performance. So what we'll say, as can be seen, from the ratio calculations. All right, how much marks we have for this part of the requirement for the comments? Let me check once again. Yes, we have 14 marks. That means 14 valid points. Okay. Uh, yeah. So from the ratio calculation, Spotty company has a higher gross profit margin than Fit company, even though it has lower revenue overall. The reason for this could be that Sporty company sources its items direct from the manufacturer, and so does not incur manufacturing costs. It is surprising that Fit company has lower gross profit margin than Spotty company, given that it is selling premium branded goods. It would be expected that such goods would be sold at a higher margin. The difference could be also be a result of competition suffered by Fit company in the year, due to which Fit company uh, had to decrease its selling prices. Okay, then what we'll say about, we will discuss about the operating profit. The operating profit for Sporty company is 4% higher than Fit company. This is not surprising given that Sporty company gross profit margin is higher than Fit company. Fit company operating profit margin is inflated because of the non-recurring dollar non-recurring $5 million gain on disposal. In addition to this, Fit company profit for 31st December 2020 includes central service, services income of $1.2 million, which will not recur following the disposal of the active division. It is also worth noting that sorry, it is also worth noting that Fit company will have a higher cost base, which would be expected as it operates its own stores, as it operates its own stores, whereas Sporty company uses department stores, Sporty company has a much higher higher return on capital employed ROCE than Fed company, as it has a higher rating profit and lower long-term debt and equity. Right now, after this, what we have to do, we have to discuss the position. Now, Fit company has a higher has a gearing ratio. Sorry, has a gearing. Fit company has a gearing ratio twice that of a sporty company, as it has much higher long-term debt. This makes Fit company a riskier business than sporty company, as it must meet these debt meet these debt repayments or would face insolvency. As a gearing for sporty company is much lower than of Fit company. Sporty company should be able to secure should be able to secure debt finance if needed for its planned international expansion. Fit company will incur much higher finance costs on its debt than sporty company, which is equity finance. Both companies can currently cover interest payments from operating operating interest payments from operating profits. However, the cash balance for Fit company is much lower than sporty company. Alright, lower cash balance applies further pressure to Fit company as it must meet high interest payments. The current year interest payments for Fit company exceed the cash balance at year end. Therefore, Fit company must ensure that its cash interest payment are sustainable in the long term. Trade payable days are 67 for Fit company and 29 for sporty company. This is consistent with the fact that Fit company has a much lower cash balance than sporty company and shows that Fit company are unable to pay supplier quickly. This could lead to problems with the suppliers in future. In future, So freight company needs to monitor its cash balance to ensure it can continue trade in the long term. Now, finally, overall, it would appear that OT company is in a better financial position than Fed company, as it is more profitable and has lower debt, and it can access to additional resources for its planned expansion. That's it. Right. So see, simply what I did, that what technique I did applied is not a rocket science. As you can see, we compute the firstly we just compute the uh, ratios. After computing the ratios, what we did, we took those ratios into account. Based on that, firstly what we did, we made the comparison between the two organizations, sport company and fed company, and we're saying, for example, let us take into consideration the GP profit margin. We said, well, which has a higher GP margin and which has a lower. And then while connecting it to the scenario, the application of the scenario, we explained the reason, ratio by ratio, performance by performance, either it's cash balance, either it's operating profit margin, either it's gearing and all, and which doing better, what could be the reason. All I what did connected to the scenario, and in the end just gave the conclusion for the one line. So you just need to do what, compute, connected to the scenario, give your opinion, move to the next ratio, and that's it. That's how you need to do it. Write small paragraphs like this. As you can see, how many paragraphs I write. One, two, one. It's like 1.2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, and 14. Small 14 paragraphs like this, and 14 points. Done. That's how you need to do it.